If you are looking to purchase your first home or rental property anytime soon, then hopefully you have already started preparing to do so because you will need the head start. Not only is it expensive right now to purchase a home because of the high interest rates, the demand for housing is extremely high because of the low inventory in the market. And unfortunately for you, when a property comes up in your price limit and it's decent, well priced, and a good looking home, you will have competition. Now, when I purchased my first property back in 2020, I did not know what I was getting myself into, and I did not prepare whatsoever to purchase a property. And honestly, if I did, I'd probably still own that property today and did not have to sell it. What I did not know is that there is a lot of preparation needed before purchasing your home or first rental property. And that's why in this video, we will be going over exactly how you should be preparing to purchase and the mistakes to avoid. Now, the first measurement in order for lenders to decide if you are lendable, meaning that they will lend you a loan on a property, is your credit score. And I want to debunk some of the rumors when it comes to your credit score, as well as give you actionable steps needed in order to better your credit score. First, here are the minimum credit score requirements in order to purchase when you're using a conventional, FHA, and a USDA loan. For a conventional loan, you're looking at a 620 credit score at least. When it comes to a FHA loan, it is about 580. And then when it comes to a USDA loan, if they have that available in your area, it's a 640 credit score. Now, there are more loans than what these three are. These are just the most typical that I see. So if there is another loan that you're interested in, just talk to your local lender and they will give you the minimum credit score requirement for that loan. Now that we know what your credit score should be, let's go ahead and set the record straight. The first myth that I want to debunk is that if you are a high income earner, that means that your credit score is high. Meaning if that you make a lot of money, that means that automatically your credit score is going to be very well. Now, credit score is based off of your payment history, amount owed, new credit, length of credit history, and your credit mix. So even if you make $400,000 a year, if you miss payments, you rack up a ton of credit card debt, and you just make bad financial decisions, you could have a terrible credit score. Now, the second myth is that closing old accounts will improve your credit score. Believe it or not, closing your old accounts will most likely affect negatively your credit score. When you close an account, you lower your credit limit and you raise your utilization on all the credit cards and revolving debt that you have. And if you are familiar with credit card debt, the rule of thumb is that you should keep under a 30% utilization of your credit cards. Meaning if across all of your credit cards you have a $1,000 credit limit, you should only spend up to $300. Now, if you're in a situation where you need to increase your credit score based off of the minimums that I showed you with a conventional FHA and a USDA loan, here are a couple ways that can help increase your credit score. The first is the most obvious and easier said than done, but it is to pay off the debt that you already have. Now, I get it, it's very expensive to live right now with the inflation of literally everything and how prices of everything are going up, but by paying off your credit card and lowering your utilization on your credit limit, that will help you increase your credit score. Tip number 2 is consider using tools such as a secured credit card. A secured credit card is basically a credit card that sets the credit limit by the amount of money you pay for. In other words, a credit card that requires you to put down a security deposit in order to open a credit card. Your deposit protects the issuer from losing any money if you do not pay back the money that is owed on the credit card. So a secured credit card is easier for people to get if you have very bad credit or bad credit history. And over time, this will increase your credit score and allow you to eventually get an unsecured credit card to where you can increase your credit score even more. Lastly, regularly check your credit score for mistakes. Unfortunately, mistakes do happen when it comes to your credit score, and you want to be able to catch it as soon as possible so it does not negatively affect your credit score. About a year and a half ago, I interviewed a woman who started off her real estate investing journey by being told that she had to put down 25% down on an owner-occupied duplex. This essentially pushed her back about a year, and she worked as hard as she could in order to save up all that money so that she could actually end up purchasing. But once she actually saved up all of that money, she purchased her owner-occupied duplex and put that 25% down. She soon found out that that was not the only option that she could have done, and she could have actually used an FHA 3.5% down loan, which would have allowed her to purchase a duplex so much faster, way earlier than what she did, and potentially be at the point where she could purchase another rental property. And the reason I tell you this story is because picking the right loan product is one of the most important steps when it comes to preparing to purchase a house. By now, it should be known that you do not have to put 20% down in order to purchase a home these days. There are a variety of loan products that you can choose from based on the capital that you have available and your comfort level. And the best thing that you could do is reach out to 3 separate banks or lenders and talk to them about their available loan products. Now, make sure that they are not all credit unions, because typically credit unions have their own terms and they may require more money down. But to spell it out for you, let's say you're going to purchase a $400,000 property and you're looking at your potential options. If you end up going with a FHA 3.5% down loan, that means that you are going to put down $14,000 on a $400,000 property. You'll have an extra expense with PMI, but you will be able to put down such little money. If you are able to qualify for a USDA or VA loan, that means that you can put 0% down on that property, but unfortunately you will be very over leveraged. You would be 100% leveraged on the property, meaning you have zero equity basically when you purchase the property. But you don't have to put any money down. And lastly, you can go conventional, which means you can put about 15 to 20% down. And if you go with 20%, there is no PMI. So at 20%, that would be $80,000 down on a $400,000 house. The downside is that you have to fork over $80,000, but it lowers your monthly mortgage expense and makes a home more affordable for you. Honestly, I believe that the best way to look at a property, even if it's a primary home that you are trying to raise your family in, is to look at the property as an investment and have multiple exit strategies. Meaning with whatever loan product you end up choosing, make sure that your monthly mortgage, your monthly expenses each month is lower than what you could rent the property out for. So in case you have to relocate or a personal matter comes up to where you have to move out of the property, you could there rent it out instead of being forced to sell the property and have a buyer take advantage of you because you are needing a quick sell. You could also make lower offers on properties to make sure you have built-in equity when you purchase it, meaning if you purchase a property at $300,000 but it appraises for $350,000, you have a built-in $50,000 spread. So if anything were to come up, you could sell it really quickly, capture some money, but also be able to afford the realtor fees and all the other closing costs associated with selling so you don't lose any money. Just remember the 3 L's when purchasing a property: location, location, location. Now the next most important step is to make sure that you appropriately save for the down payment when you purchase and your savings for after you purchase. Let me tell you why. The home buying process is a very expensive process. Not only will you need money for the down payment, you will also need money for the earnest money, for inspections, the appraisal on the property, maybe re-inspections if it calls for it. And the biggest one that people tend to get confused by is the closing cost that does not include the down payment. With all that being said, just having the down payment for the property is not enough. And luckily, if you know the loan product you're going to use, you can easily estimate the down payment. For closing costs that is separate than the down payment, the rule of thumb is between 2 and 5% of the loan amount is what you're probably going to be paying in closing costs. But it does vary based on your area. The best thing that you can do is talk to an experienced agent in your area that can guide you through the process of estimating correctly what all of these expenses will entail. But the most important part is that when you purchase a house, banks are going to require you have between 3 and 6 months reserves. So in case anything were to happen, they know that you will still pay the monthly mortgage. And what I mean by that is 3 to 6 times the monthly mortgage in your bank account separate after all of the money's taken out for purchasing the house. So for example, if your monthly mortgage is $2,000, they want about $6,000 to $12,000 sitting in an account for a rainy day just in case something were to happen, if you lose your job or anything else, that they know that you can pay that mortgage. Now, please, please, please do not do any of these things I'm about to talk about while you're under contract or before purchasing a property. The first thing is do not go and get your credit pulled. As a real estate agent, I have seen this time and time again, and I've advised my clients to wait till after purchasing the property in order to buy that brand new shiny car to go along with it. I know it looks amazing and it'll go perfectly sitting right outside your brand new home, but by getting your credit pulled before purchasing a property could affect your loan and affect you even buying the house altogether. And if you get that shiny car before closing, you may not even be able to purchase the house, but hey, maybe the car is very comfy and you can sleep in that. The reason I stress this is because not only do they pull your credit and check it while you're under the application process and you're applying to get a loan for a property, but they also check it at the very end, right before you close on the property, to make sure you didn't do anything crazy like I just mentioned. The second is do not change employment while you're under contract or before you purchase a house. Now, if you're way before the application process and you're just casually looking at houses, you're probably like 3 to 6 months out, that's a different story. I actually had a unique situation where I had a client quit her job the day of settlement, signed off that she still had employment, not knowing and not understanding that she's basically committing mortgage fraud. But she ended up saying she still had a job, closed on the property, and about 2 weeks later, they ended up checking her employment again to find out that she was unemployed and she still had this loan ahead of her. And unfortunately, although they didn't know what they were doing, the bank could have called the note due in full, meaning that they would have to pay all that back right away. Luckily for them though, they worked something out. It was such a low amount that they just added a co-signer to the loan and the bank agreed to work with them. But you may not be so lucky if you find yourself in this situation. Now you know exactly how to prepare yourself financially before purchasing a house. If you found this video entertaining or valuable in any way, I greatly appreciate if you hit the thumbs up, subscribe to my channel, and watch this video next. See you in the next one.